The multi-million dollar question. Would you select ETF A that pays a 9% yield or an ETF B which has a 3% yield? Which one would you actually buy? That's the big question out there. I'm Doug, the retirement guy with all your monthly ETFs, and this is a question that a lot of people question and ask. Now, I can tell you, majority of the crowd will say, buy ETF A. I need the 9%. There are some who are thinking that this is a trick question, and they'll say, well, I'll switch to the other side of the 3% yield, probably a safer bet. Well, this what happens to everybody when they sit down and start trying to plan their long-term retirement picture, their long-term retirement plans, and they just use the what we call the common error of picking ETF A for 9% or picking ETF B at 3%. We're going to give you the real answer to this and why the answer is what it is and what to look for to make sure that you're not falling into the traps that ETF sets. Before we get into that, I got to do a shout out to all of our Patreon supporters. Thank you so much for being part of our family. Now, if you're not part of our Patreon group, don't panic, don't worry. And this is not an ad campaign because our Patreon is free. Now, you can buy a membership to support the channel, but overall, we give everything away for free. So don't be afraid. Hit that logo down at the bottom. You'll join and get information accordingly. Now, in 2026, the market analysis, the wealth builders versus the yield traps, it's a competitive review of dividend ETFs. So the question was, which one's better, ETF B or ETF A? Well, let me show you ETF Bs first. These are really wealth builders. A Charles Schwab SCHD, a VYM, a VIG, both Vanguard packages. They have a consistency in dividend growth. They have low expense ratios and strong fundamentals. The risk level on these are extremely low. Over on ETF A is what actually is the yield traps. High yield, low quality ETFs, SDIV, RET, and one that a lot of people own. And I will tell you straight out, I've owned this for years, QYLD. Okay, they have unsustainable payouts, the declining share prices, and high volatility. So their risk level is extremely high. Now, the key metrics here. In 2026, $2.4 billion under assets under management, 15.2% total return. These are off of the ETF Bs. An average yield of 3.2% and expense ratio of 0.06%. So when you combined all that together, which one would you actually pick? Well, if you take away the yields, take away all that, give you the information on the screen here, ETF B is probably your right choice. So the foundation of how dividends actually work, a lot of people don't even understand this part, and if you do, congratulations, but you are a bigger share do not understand this. Companies, that you own shares in a dividend paying company. So if you own ownership of 100 shares and the price of it is $50 a share, that means you own $5,000 worth of the company. 50 shares, $50 shares, $5,000 investment. Now, the profits from the company, basically in a program set up that they pay out so much per share. Okay, so we're just going to say the EPS is $2.50 for a payout of $1.25 per share. The yield would be 2.5%. So the annual dividend of $125 or 2.5% yield. So the cash to your pocket, you receive cash payments quarterly. So quarterly, $31.25. Annually would be the $125. But now here's the big thing, is the growth. As the company increases its profits, the growth of the fund will go. This is where we start getting into what we call the aristocrats that have been paying out dividends and growing their dividends year over year. So dividends are not just a number that a company picks and says, this is what we're going to pay. They work off of dividends, off of a mathematical number into what goes in your pocket. So that $1 million question I asked you, which fund is actually better? ETF A at 9% and ETF B at 3%? Well, the real answer to it is neither or, because what you want to know is not what the yield is. You want to know what the total return is. Okay? I could say there's 3% ETFs that I would never hold. And I will also say there's 9% ETFs that I would never hold. And there's some that I would say I'd hold both. But what you have to do is not just watch the yield. And you've heard on this channel many a times, I said, we are not yield chasing. And that's what this is. Because it says 9%, it makes it better. I'm chasing yield. 3%, not as good. But we got to find the total return is your true answer. Now, before we dig deep into each fund independently, which we'll cover here, I wanted to share with you what the B category is, the 3%, why these things are winning. Those three different ETFs, I will tell you right now, is made up of over 500 different companies. Okay? They have a big safety net because they're in 12 different sectors. And why is that important? Well, if one sector is off, you have 11 other sectors pulling its strength. Okay? It's like the old answer of a chain. What's the weakest part? Okay? One piece is the weakest part of the chain. That's why you put 12 links into this one, so that you have other links to make up for it. Diversification, 500 different holdings, 12 different sectors, the average yield of 2.50%. Okay, it's not huge, but you remember, you got growth. And only 0.06% expense ratio, so extremely low. So you're getting that consistent dividend growth, which is what everyone always forgets about. That 2.5 is what it is today. And yield is just a mathematical number. As the price of the share goes up, the dividend will go up. As the dividend goes up to the price of the share, the yield will probably stay the same, but that's not what you paid for the shares. Low volatility, recession resilience. And the portfolio stability is about 95%, so extremely low. That's why these three funds are very safe ETFs in the market. Now, these are also funds that we highly recommend what we call DRIP, and it's a snowball effect. And this is for people who are, 20 years away from retirement or so, or anyone just starting off. So if you put $100 into a fund in 1 year, 5 years later, you keep taking all those dividends and pouring them back in, you'd have $250. 10 years, you'd have $600. 20 years, you'd have $1,500. 75% more shares after 20 years of just reinvesting the dividends only. So the growth analysis of all this, and this is where I really start playing into it, that if you were putting $500 a month and dripping enabled, okay, 20 years from now, you'd have $1.2 million potentially, a 15% annual return, $125,000 in dividends, and 75% more shares in 20 years. This is what we call the snowball effect and the dripping effect of ETFs. This is how people grow their portfolios. Now, unfortunately, the yield trap warning, and the warning is yield trap, 9% yield with a negative total return. And this is where I'd come back and tell you total return is your saving grace, is your answer. A 9% yield looks like free money, but it often is a warning sign. Think of it as a vending machine giving out dollars while it's slowly sinking into the floor. You're collecting cash, but your principal is disappearing. 15% total return negative. share price down 25%. These are the things you have to look at when you start looking at ETFs and dividends, along with stocks and everything else. So let me show you the case study where it really shows the example of what's going on. Here's the first fund, SDIV. This is a Global X Super Dividend ETF. I'm being honest with you. I owned this one. I thought I was the hero. I thought I was really cool. When I bought this originally, I said, oh my God, I'm getting myself 9% dividends. I don't think it was even that high when I first purchased it. But the market was getting a 0.5. So I'm like, oh, I'm killing it. I'm the greatest. I'm the smartest. And then I got taught about total returns. Over a 3-year period, it was down 12.8%. I argued with myself and said, oh, that's just market conditions. The price went down. The answer is wrong. It was like the sinking machine. I was gaining 9%, losing 12%. And I could never argue it. I could never tell somebody, I'm getting 9, I'm losing 12. How is that a positive number? So when you take a look at this, when the expense ratio is 0.58%, so a lot more of my money is going to expenses versus investment. $890 million into this fund, the volatility rate 18.5. So this whole thing comes into a dividend paying out of $920. Capital loss is $1,280. So tell me where you're gaining money at 9% when your total return is a negative 12. And these are the things that you have to look at, not just yield, but you look at the total return. Once you establish those two numbers, then we can do bigger dips. We can look deeper into it and see what's going on. So the 4-point pre-checklist for buying any ETF and working with anything. First off, what's your yield range? I'm not against 9%ers. I'm not against 12%ers. I have a lot of these out there. Okay? But I'm looking at what's a healthy yield range? 2 to 5%. What's your expense ratio? Okay? Anything below 0.1 is excellent. But when you start coming into a fund that's paying a bigger target, you also have to be asking, what's the yield? And what's the total return, and what is my actual cost, and what am I getting out of it? So like I said, anything at 0.10 or below is excellent. Total return, which is your price plus your yield. And this is where I tell people, okay, you look at 1 year. That's always great. But let's try to look at the 1 year, the 3 year, the 5 year, the 10 year, since inception. When you see numbers being posted on the board of a 12.5 or a 28.3 over 3 years, okay, take 3 years into that, you're a little over 9% average. That's what you're targeting for. You're trying to target a 9% average across the entire board if you want 9%. If you want 3%, you're going to want to target that over a long period of time. Then you know the fund will pay. Track record. You want to know, has it survived recessions? What has it done? This is why we tell people before you buy anything, we're talking about 3 to 6 months before you invest $1 into any brand new fund. And when you get into your retirement, you want to have that track record easily into that 10-year mark. I was taught that a long time ago. You want to invest your money? Yep. Find something, at the time it was mutual funds was the big one. Find a mutual fund that has a positive track record for over 10 years. Even though history doesn't repeat itself, but you know what happens? A lot of things happen during those same periods of time. 2008 crash, the 2020 crash. Okay, there's crashes all the time. How did a fund last during crashes? How did it work in the upside? How did it work on the downside? What was its recovery? And the track history can tell you that. So depending on where you're at in your life, if you're just starting off planning for retirement, okay, this is what you want to look at. If you're into retirement, getting your portfolio ready, make sure you're set, ready to go. And the track history can tell you that. Maybe you don't have to look out 10 years. Maybe you can look out 5 years. But look at the track history. So when you get a fund that checks all 4 boxes, you get an approval. This is a no-brainer. Take it, run with it, you're done. Now, if you want to get something at 5%, make sure all of these boxes are filled. Let me show you one that we talk about, SCHD. I talk about this on the channel quite a bit. This was a fund that I've personally owned many, many years back. It's probably one of my first ETFs I ever bought. And I really don't even know, quite frankly, I didn't know what I was buying. I read up about it. I was told about it. And I thought, oh, this is the greatest thing ever. I'm collecting dividends and so on. And I didn't really know what I was buying. And I'll be honest with you. I mean, there's no sense of lying to you on this channel. Charles Schwab program is 0.06%. I really didn't know what expense ratios were, but that's extremely low. And it paid a 3.5% yield, which, most banks, I can go to a bank now and get 4%, 5, in my savings account. So why would I even have this? Because it's 10 years of dividend growth, its low volatility, and its quality screening of its funds gives long-term returns, long-term projections. I put down here the performance of the past 5 years. I could have went out farther. But look what it's done. Compared to the S&P 500, and I always laugh at this because the S&P 500 is the benchmark that we work from. Okay? Look at Charles Schwab. It almost follows it to a T. When the crash comes, when S&P drops off, guess who doesn't? Charles Schwab. Do you cap your upside? Yeah, your upside's a little bit capped of what it's going to. It's not going to grow, but it's maintaining, keeping up with the S&P 500. That's where it's a win-win situation with some yield added to it. Why is it doing this? Because of its holdings. You see how this is like I always use the onion structure. We start peeling the onion back, and the more layers we get, and the more layers we get, and the more layers we get, till we get to the core. Okay? So we started off seeing a 3.5 yield. It doesn't really excite me. I can get that in a savings account. When you do this over a 5-year period, it's following the S&P 500 for performance. It has a 10-year growth. Another layer we start digging into. The top holdings, Coca-Cola, 4.2%. Lockheed Martin, Texas Instruments. Okay? They're not huge in one particular brand. Coca-Cola, 4%. Okay? These are things that they put money into and spread it across the entire market. The Charles Schwab focuses on companies with 10 years of dividend growth and strong financials. It's designed as a core holding for long-term wealth building. If you haven't seen my retirement portfolio 3-bucket system, I highly recommend you watch the video, not because it's mine, but it can answer a lot of questions for you long-term. And this is one of them that is actually in that portfolio. And it's in my growth section because of what it does. It could easily be in the core sector, but it's also in the growth sector because of what is long-term wealth building potential. VYM, the broad diversification. This is the Vanguard high dividend yield ETF. Now this one is a 2.5% yield, but look at the expense ratio, 0.06. This is the one that has over 500 different holdings. So you got a broad diversification, you have a low expense cost, and you have a quality focused program. That performance again, look at the performance to the S&P 500. When it drops, it doesn't. And when it climbs, it maintains it. The top sectors, healthcare. They're into technology, but not the big 30, 40, 50% you see from a lot of funds. It has industrial sides of things. Okay, VMY holds 500 stocks across all sectors. It's providing a broad diversification that complements concentrating ETFs like Charles Schwab for conservative investors seeking steady income. This one, again, is one of those funds that you may put into your secure, safe portfolio, as a foundation piece because it's working with the Charles Schwab side of it for the income and growth, but still able to grow across the board. And that third fund that we talk about is VIG, the Growth Index, the Vanguard Dividend ETF. Now the yield, 1.6%. Again, nothing going to write home. You're not going to retire off of this one fund. But in a system, in a package, it starts developing. 6% or a 0.06% expense ratio, holding over 200 different funds. Look at it up against the 5-year mark of the S&P 500. It's outperformed it, to be honest with you. Microsoft Technology, Johnson & Johnson, Procter & Gamble, all companies on the Aristocrat program. This one's buys focused on companies with 10 years of consecutive years of dividend increases, lowering current yields, but strong growth potential across the board. Again, another one that fits into the 3-bucket system. Now, how does this all compare? Well, JEPI. We come in with JEPI across the board. 0.35% expense ratio, so your expense ratio is up. 7.8% yield with 134 different holdings. This one's in a lot of retirement portfolios. And I'm not saying it's a bad fund. Okay? But how does it look total returns across the board? When you look at the 1-year performance, it's outperformed the S&P 500. Because it's built for income, not growth. So the magic toggle, reinvesting your dividends. Always make sure your drip is on if you do not need the income. If you're 20 years out, you don't need the income. If you're 10 years out, you probably still don't need the income. When you start getting within a couple years of your retirement, then you can start turning on your income side of it. So you can start getting adjusted to what your income future will be. Especially when you get into retirement, you need that money. 75% more shares after 20 years if you just take and invest $500 a month and roll your drip on. We talked about this previously. It is a huge difference with and without dripping. This is what makes a 20-year impact on your fund so critical. So that question I asked, that multi-million-dollar question, ETF A or ETF B, which one is the real answer? I just showed you examples of 4 different funds. And I gave you an answer of A and B if you didn't realize it. Because the true answer is not yield, it's total return. It's where you're at in your life. It's where you're at today. Buying funds that you just see on some YouTube channel, you need to do your legwork. You need to do your research. Find out what fits you, the holder. So the answer to the question is A, B. Some A's are really good, some B's are not good, and some B's are great, and some A's are not. Start off with total return. I can't stress that enough. So if you have any comments, leave them down below. If you like the video, hit that like button, helps the channel the most. And especially if you're want to be a part of it, don't be afraid to join our Patreon group. I'd love to hear your thoughts of how this all works. I really think this is an area that a lot of people don't understand, and that the yield is so critical. But really, guys, I'm telling you, total return is the way to go. It turned my life around, and I want to make sure it helps you. Let me know in the comments below.
Thank you for watching. Press the like button, hit the subscribe button, and join. Leave any comments below and join